Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gives you complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Harihar of HRBV Client Solutions and independent advisors Vivek, Mavani and Sharmila Joshi join us on the show. Thank you to all of my guests for joining me. Today on Hot Money, we'll discuss Page Industries. Again, on the numbers, there were a lot of adjustments, post which Page fell in almost 10% on Friday. Is it a good time to start accumulating? Is Jet Airways a pick as far as the turnaround story is concerned? Should ITC be accumulated? It's one stock which has been resilient in the market fall. And we ask about one mid-cap stock that looks attractive. Most of the mid-caps have corrected 30, 40, 50%. So is there some potential of a mid-cap stock that should be accumulated at this level? That's something that we will ask our guests. Let's start with the first one. Page Industries has been looking weak ever since the numbers came out. Again, there was this adjustment that came in terms of that was done. So instead of a 20% growth that would come in, the growth probably would have been in less, close to 14% if you adjusted for the Ind AS adjustments that came out. And the markets didn't like that and saw a big sell-off in Page Industries on Friday. Page again has been down almost 35% in the last 6 months. What's the view ahead on Page Industries? That's something that we will discuss with our guest. Page Industries, initially we thought numbers growth was 20% and then this adjustment that they put in the footnote. Market realizing that and a 10% sell-off. Today also Page is trading weak. At these levels, is it a good buy? Considering that it's corrected all the way from 36,000?
See, a couple of points. I think we need to look at two independent issues. One is the accounting adjustment. Second is whether it's worth buying at these prices, notwithstanding all the other factors. I was watching a lot of channels talking about the accounting adjustment. Let me tell you, this is not something like accounting jugglery that it's being made out to be. It is just a shift to IND AS 115 standards, which is a different standard for revenue recognition. And there's a one-time impact that you're saying. It's not a regular impact, it's a one-time impact. So my understanding is I think the sales are probably higher by about 25 crores and the profit was 7 crores, which is, I think, not really substantial. So I don't think that the IND AS 115 adjustment is really very significant, and it is not a corporate governance issue as it is being made out to be in a lot of places. I think it's not a corporate governance issue. The bigger question is, I think, about the valuation. I think that is where we have a problem with the Page. Because at the end of the day, I think it is in what I call a low value add industry. It's an industry that still has a lot of competition from the unorganized sector. And it has been quoting at very rich valuations and consistently appreciating over a period of time. I think last 1 year, I agree it's been down about 30%, but I think even at these prices, to me, it looks to be quite stretched. So while I'm not really worried about the accounting adjustment, we really wouldn't go out and buy this stock at these valuations.
Okay, it wasn't about any kind of corporate governance issues. It was basically that, when Page actually last quarter, when the growth rate fell into 10% from the historic 20-25% that they were doing, the counter has corrected significantly. Again, the thing was that people thought it will be a 20% growth, but still they haven't been able to do it. So my question is will Page now on a higher base be able to continue that 20% growth going ahead, or should we accept that 10 to 15% should be taken as granted? That
I think 10 to 15 would be par for the course. I don't think a 20% growth at these levels is going to be possible. But I think even if they can grow it closer to 15%, I would still believe the stock is a quality stock. But I'm worried about the valuations. But I think the P ratio is still too rich even after the 30% correction. So I don't have any issues about the growth. And I think, as you rightly said, probably the current profits are a little overstated because of that. But I think that is fine. I think changing accounting standards is something that's absolutely par for the course.
Okay, Sharmila, what did you make of Page Industries? Would you accumulate? People at 35,000 were ready to accumulate. Now you're getting it at 21,000.
So I think it's a twofold problem. First is I think that as you were saying that it is actually really the Q1 numbers that Q2 numbers that disappointed, and you saw the big correction come on the stock, and which is why when the stock corrected already 35%, and then when this quarter's numbers came, market thought that they were okay. They're sort of back on track, as you said, 22% growth, 20% growth, whatever, and things are beginning to look okay again. So I think what market didn't like was not the fact that, not like from a corporate governance point of view, but that this issue was not highlighted. That this is this growth has come because we have changed our accounting standard, and it is not really this, and that you need to keep that in mind when you look at our numbers. So because I think they didn't highlight it, and that is why I think you saw this last sell-off that you've come. But I agree with Harihar in the sense that I think it's still a valuation concern because valuations are still high, and this is sort of a period that we are going through just now in the market as a whole, where you're not really very convinced about any story anymore, and you're willing to punish anything. There is like absolutely no room for error, zero. Even where stocks have delivered, they haven't really run away anywhere. So I think in light of that, wait for now. Though valuations are beginning to look decent to me, this is a stock that I like. But I think wait for now, wait for next quarter numbers to come in. Hopefully a lot of things will be more clear. Even I think, when you get that number, you will have this definitely again, you will know that this number is because of, you will already know this, there is no need to therefore then say that accounting standards have changed or whatever, and you will keep that in mind, and it will be more comparable to this quarter, and then you will take it from there.
But I'm asking, will it be tough for Page, valuations leave aside, will it be tough for Page to, maintain that growth
for
rate?
A while, definitely.
Given that competition is also now picked up.
No, I think more than competition is just the mood the general, consumption play is in, and what I like about the fact, in fact, is that there was, if you were to look at the way the numbers were coming about, 2-3 quarters back, that there seemed to be a definite shift towards branded play. Though this is that way, in a sort of a section in the market which is considered low value or whatever, there were people willing to pay that price for a brand because they respected that it was a global brand, that Jockey was a global brand, and you were willing to pay the price for that. But I think, for that you will require the overall sentiment to improve. So that could probably take 2-3 quarters more.
Okay, Vivek, what's your assessment of Page Industries at this level?
Well, I tend to agree with both Hari and Sharmila. Valuations continue to be rich. Just to put things in perspective, last year when it was at 36,000 at the highs, it was trading at close to 100 times earnings, if I remember the numbers correctly. And even now, it trades at something like 60 times earnings for current year, 50 times for next year, which certainly are not attractive or cheap by any standard. That's number one. Number two, now, okay, there was a large section of the market which was willing to pay 100 times earnings. What we saw in the bull market between 2013 and 2018, good quality consumption plays actually had got re-rated, in the sense multiples had expanded, where 70, 80, 100 times earnings was being justified as a new normal for some of these companies, whether it's Page or Eicher or Astral, Poly, and several such high-profile names, which assumed that they would continue to grow at 25% for a very long time, whether it was 5 years, 10 years. Now, that assumption may have been fair in a bull market where actually Page was delivering 25% earnings for almost 10 years. They did deliver. What we now have a slowdown is only in the last 2-3 quarters. The latest quarter being an accounting adjustment. Net of that, also on a like-to-like, there's been a 14% growth. Competition, meanwhile, has intensified from Aditya Birla Fashion, from some of the other foreign brands which have also launched business in India. And of course, the domestic players, the likes of Rupa and others, also upping the game in terms of moving up the value chain in terms of premiumization of their product portfolio. Net, what you would have is that a moderation in growth rates both for the sector as well as for Page. So maybe the 25-30% growth is probably not sustainable. And I mean, that's no more a normal. Maybe the new normal is 12 to 15% growth, which may sustain over the next 3 to 5 years. Now for a 12 to 15% growth and a 40% return on equity, which probably will, not just probably, I'm certain will sustain in case of Page, 60 times or 50 times forward earnings may still be difficult to justify. So maybe the valuation multiples over a period of time will also moderate to maybe 25-30 times over a period of time. Now, whether that happens with just a collapse of stock price or they just grind over the next 12 months with earnings growth catching up and the stock really is staying either in a range with a downward bias, I think that adjustment is happening. Not just for Page, it's happening for a large number of companies, as Sharmila mentioned. Even companies who have delivered on earnings growth, it's not that the stock prices have really gone up. Even there, the stock prices have corrected even after good earnings. So what we have indirectly is that the multiples are contracting, and maybe that contraction of multiples, the reverse cycle that happened between 2013 to 18, a reverse cycle probably will happen in 2019 and maybe even go on in 2020.
Okay, that's the view on Page Industries. I think valuation concern seems to be the forefront of our discussion today. The next stock we want to talk about is Jet Airways. Jet, I think, is doing well in today's trade. Came out with numbers and then there was this conference call. Again, there's no denying Jet is in trouble. It needs a lifeline. What they've said is also the all-important jet privilege that they're looking to sell probably won't happen anytime soon. So that's something, but it's been a marked underperformer, down 70% in a 12-month basis. Sharmila, will you play Jet Airways as a turnaround story?
So first off, let me confess that aviation is a space I don't like. So I've never really been a sort of somebody who has recommended aviation stocks. I think 2 years back, very reluctantly, I had to sort of admit that numbers are beginning to look better in terms of occupancy and things like that. And because crude prices were also trading lower, there could be a sort of a buy case to be made out for some of these stocks. But now I think absolutely the reverse is true. So I think first off, there is no clarity on really what is going to happen with Jet. You just hear probable sort of investors. You now hear of Etihad. You heard that SBI could convert its debt into equity. So I don't know how that, I mean, God help SBI once it gets that. But you don't know what is happening with Mr. Naresh Goyal. So there are so many uncertainties still, you know. Then there was this big talk that Tatas could be looking to invest. So we don't know who the investor is ultimately going to be and what are the conditions going to be. I mean, the conditions that they lay down and what is really going to happen, going forward with this company. So I would think that let that clarity emerge. And in the meantime, I think, there's this overall sluggishness in the aviation. We've seen the sort of the numbers come off for all of the, whether it is Interglobe, whether it is SpiceJet. I would think that the best placed among them is Interglobe, but in terms of market share, etc. But even there, they've seen, sort of contracting numbers month on month. So I think that sluggishness is there. Plus, crude concerns are there now. I don't think we can get away from the fact that crude is also now sort of in a range and we don't know whether it is going to go much higher or if it's going to correct from this range. So I think all in all, just stay away from Jet.
Okay, what about you, Vivek? Aviation, Jet, would you buy this or would you avoid?
Well, I would absolutely avoid both Jet and Indigo or even SpiceJet. I would avoid in the entire sector. I mean, there are structural issues, issues as regards the business model itself. And I think the business model is broken, if I were to put it harshly. In case of specific to Jet, Etihad may invest, the banks may convert the loans to equity, but that probably only gives them a lifeline to carry on for few more months. There is really no turnaround plan on the table as to how that turnaround is going to happen. And to be fair to everybody, what turnaround plan can they give in an environment where, as far as the airlines, the aviation sector is concerned, high fixed costs because of lease rentals, which are committed payments, including and staff costs, a high fixed cost. The large variable cost is your fuel price, which is linked to the crude. But what we have as a result, when crude prices rise, airlines don't have the pricing power to increase their fares or ticket prices in line with increase in fuel prices. If crude prices fall, there is more than proportionate fall in the ticket prices. So basically, there's no pricing power. So you through the crude price cycles, you really don't see margin expansion really happening, which ideally should be the case. Now, will that change anytime soon? Unlikely, because what we have is supply in terms of seats available much more than demand, although demand has been growing at 20% month after month for the last several years. Supply has more than kept pace, and that is unlikely to change. In case of Jet Airways, how do they get out of this scenario? Well, anybody's guess, and I think nobody really has a plan, including Etihad, whether they have a plan to turn around Jet Airways anytime soon. So, net, why would what really is the rationale for being bullish on aviation sector? So there's really no merit or case I can make out for investment in not just Jet or even Indigo, or Interglobe or even SpiceJet.
Okay,
yeah.
Okay, you have something more to add?
No, just the last point in lighter vein, that there are some businesses or some sectors where it is better to be a customer than to be an investor. And aviation is one. It's better to be a customer than to be an investor.
Okay, fair point. What about you, Hari? Will it be a 3-on-3 negative on Jet?
There are two ways to look at Jet. One is, I think, the very short term, and the other is the slightly longer term. I think in the shorter term, it could possibly be a good positive trade because the worst seems to be over, the uncertainty is out of the way. So it could be a positive trade. So any dips, you can probably look at a positive trade. On the longer time frame, I think there are two things we need to understand. See, globally, this is going to be the best year for aviation. In fact, $32 billion is going to be the cumulative profits of all the airlines put together. So it's not like all airlines are losing money. It's only the Indian aviation companies that are losing money. So I think there is a very structural issue that we need to address. Once that is addressed, I'm sure the jets and others should do well. There are concerns on two fronts as far as I'm concerned. One is, I think, what is going to be the role of Naresh Goyal? Because I think either they have to have him in or they got to have him out. So unless that uncertainty continues, I think valuations, it will be an overhang. Number two, I don't understand why they are diluting the equity so much, because what is going to happen is now, let's say the share capital of Jet is X. So they're going to issue another X number of shares and these shares will be issued to SBI. So SBI becomes a 51% shareholder. Now, the questions are now twofold. Number one, what happens to the stock price after the huge dilution? I'm sure the price should really crack sharply from these levels. Number two, and the bigger question is, what is SBI going to do with the 51% stake in Jet? Because I don't know what can SBI do with an airline. They are struggling to run a bank, so I don't know what they're going to do with an airline. So that's a big question. So I think the only reason to me it looks suitable to Naresh Goyal is that he has two people, Etihad and SBI, both of whom don't have a very long-term view on on the aviation business. He's afraid of the Tatas because he knows Tatas is there for the long haul, so he doesn't want Tatas to get involved. So I don't think they're going to get involved. So it's probably going to, oscillate between Etihad and SBI for some time. Probably 2-3 years down the line, the control goes back to Naresh Goyal. That's what we see. But I think the uncertainty is just too much. So long term, we stay off Jet Airways.
Okay, so that's the consensus view coming in. Long term investors should stay away from Jet Airways. Hari said for a short term bounce back could be possible, but it's not there for the long haul. The next one we want to talk about is ITC. ITC has been pretty resilient in the times when the markets have corrected significantly. Today is down almost close to 1%. And remember, because of the Bharat 22 ETF, there could be buy flows that could come in. But on a long-term basis, is ITC a stock that you would accumulate or have in your portfolio? Because for the past few years, it's done absolutely nothing. Actually, for the last 12 months, the good thing is it's given you a profit, while most of the stocks have given you a loss. Vivek, ITC, is it a must-have in your portfolio, or would you look at better things?
It is certainly a must-have in the portfolio at this point of time. I mean, a serious defensive, if one may say. A serious defensive and a low beta play. Now, coming to the performance. For multi-business conglomerates like ITC, it's very rare situation through multiple business cycles that all of the businesses are doing well simultaneously. All of them have an economic or cyclical upturn. In case of ITC, this seems to be a rare occasion in the last 20 years where your core cigarette business continues to chug along at about 8 to 10% profit growth. The FMCG business, non-cigarette FMCG business, after a stellar turnaround, is expanding margins on a quarterly basis. Now it's almost close to a $2 billion business of a serious size and scale that they already have, and with deep pockets to get into new segments and a regular product launches. The paper and hotels both are on a cyclical upturn, which is likely to sustain for the next 2-3 years. Now coming to the valuations, ITC traditionally over the last 20 to 25 years has always traded at a discount to other FMCG companies like say an HUL or a Nestle or a Dabur, etc. Partly because of the conglomerate nature of having two other businesses which are unrelated to FMCG. Partly also that return on capital and return on equity was significantly lower than the other FMCG companies in terms of on a comparable basis, in spite of much better cash flows from operating businesses as far as ITC is concerned. So that discount of valuation was justified. Now what we have is all of the business chugging along at double-digit earnings growth, much of the investment in growth behind it. So what you will now have is an expansion of P&L account disproportionately larger than the balance sheet, leading to return on equity, return on capital rising probably much faster. Hence, what we could have over the next 2-3 years is the valuation gap between ITC and other FMCG companies narrowing. Okay. Now, I'm not advocating a serious re-rating of ITC at this point of time, where the whole market is getting de-rated, where the multiples are contracting, but at least ITC's multiples could stay where they are. And what we have is 15 to 18% earnings growth over the next 2-3 years, which gives you your returns on a low downside risk, low beta play.
Okay, what about you, Sharmila? ITC, would you advise someone to have in their portfolio?
Yes, I think so, because I think the concern for me for ITC is the fact that cigarettes, if you look at it globally, is a dated business. I think that at some point in time, these could be the businesses where you would not get the kind of growth numbers that you're getting now. But for now, I think in the Indian context, and I think ITC as a company has realized that because they have forayed into FMCG, paper, hotels. These were all separate companies. They merged them back into one. They have that agro piece. So, even if you look at this quarter's numbers, cigarette volumes were fairly decent. FMCG did a very good growth. Paper and hotels were a little sort of okay, but there is a good possibility going ahead. Valuation-wise, it looks okay. So I think on all fronts, in that way, ticks the boxes as far as I'm concerned. In the sense that it's a business that is growing decently, available at decent valuations, and a low beta play, as Vivek was saying. So it doesn't really. And this Bharat 22, I think in the near term it has provided a bit of an upside, but I think in the longer term there could be a cap on the price, if you ask me, because everybody who wants the stock will sort of get it. So it may not run up in a hurry. So that I think could be the negative, but I think that they're approaching things very, it will be when the other businesses become larger than the cigarette business that you'll really say it's a screaming buy. But for now, I definitely think it's a stock you can accumulate and keep in your portfolio.
What's your view on ITC?
We have traditionally been negative in ITC, both the business as well as the company. And one of the reasons we have a problem with ITC is that it is still a cigarette business. If you look at the total profits, but I think 85% of the profits still come from cigarettes. Number two, if you look at the ITC FMCG foray, I think it has been one of the big disappointments of the last 20 years. Yeah. Where I think be it food, be it detergents, be it any of the fast-moving consumer goods, they've actually been a big disappointment. They've not been able to ramp up the way a Hindustan Lever has done, or probably a Dabur or a Marico has done at the middle level, or someone like a Nestle and Britannia have done the food side of the business. So to that extent, I think ITC FMCG has been a big disappointment. So we are really not big fans of the stock. And I was watching the chart of ITC, the last 3 years chart. I think it took about 1.5 years for the stock to go from about 260 to 340, and then it came back from 340 to 260 in just one day. So that is the kind of volatility that the stock shows. So we typically avoid the stock. We like these global MNCs, which are very, very simple businesses, likes of Nestle, the likes of Britannia. We can complain that the valuations are rich, but I think that is the way FMCG companies are. So if we have to buy an FMCG company, I think it would be one of those, the likes of a Britannia or a Nestle, definitely not an ITC.
Okay, that's the view that's coming in, and we're running out of time. So first, we very quickly come to the last pick, and that is the mid-cap stock that should be accumulated, at least for the long term. Hari, you start, which stock would you recommend?
Manappuram Finance, I think we like the stock, reasonably priced at 105. I think good numbers. More importantly, I think unlike the whole lot of NBFCs which are under stress because of liquidity, these people don't have that problem because they are more into what I call the gold spread business. They borrow gold, sell gold, work on the spread. So they're not really hit by the NBFC liquidity crisis. And I think it's about 10.5 to 11 times historical valuations, 8.5, 9 times forward valuations. So we think that most of the the downside risks are into the price, and at 105 we don't see much of a downside risk. So I think a fairly good buy on the financial space at this point.
Okay, Manappuram is it, and what about you, Sharmila?
Well, I like IT as a sector. In the past, I've recommended large cap IT. I will go with Persistent System. Here, I think results were okay and fairly good, in fact. And so their verticals are growing nicely. Good contribution from digital, which is obviously the space to watch. They are likely to get a new MD CEO, and I think that will mean good things for the company going ahead, because he will definitely look to drive sales, etc. Better. And I think it's now available at fairly decent valuations, and they've got a good order pipeline, and things look positive for them going ahead. So I think this would be a stock to look at.
Okay, what about you, Vivek? What's the thing that you're recommending to your client?
My preferred pick is Bharat Electronics. I mean, the defense PSU in terms of the growth opportunity as well as the valuation correction. I mean, as your visual shows, I mean, a 50% correction. Actually, it's been more than 50% if you take a slightly longer term view. I mean, from a high of 190, it's at 75 rupees now. So, I mean, more than a 60% correction. What we have in Bharat Electronics, a 25-year track record of delivering 15% earnings growth year after year with a return on equity of about 18% for a 25-year period. And not even 10 companies in India will have that kind of a track record, barring an HDFC Bank, a Kotak Bank, a TCS, Asian Paints, but the names are just few. Bharat Electronics is one of them. That's number one. Number two, so one is a track record. Number two, On a last year's revenue number of about 10,000 crores, what they have is an order book of close to 49,000 crores, which is enough to take care of 20% growth for at least next 3 years or 4 years, and orders continue to flow. So in terms of growth opportunity and the growth availability with fixed margins, because all of these contracts come with assured margins, so in that sense, the sustainability of margins and return on capital, return on equity is also pretty much assured. Post this almost 55-60% correction in stock price, it's now trading at just about 6 times EV by EBITDA, a net cash company, zero debt company with a few hundred crores of surplus cash on the balance sheet. My sense, it's about close to 1,000 crores of surplus cash on the balance sheet as of March 19, what we will have in the next month. In terms of earnings, just about 10 times earnings, which is historically low compared to what Bharat Electronics has traded over the previous 10 years or even previous 15 years. It's also low even when you purely compare a company with this kind of a track record and a debt-free, clean balance sheet with return on capital, return on equity of 18%. So at 6 times EV by EBITDA, 10 times earnings, Bharat Electronics is pretty cheap. Now, the concerns have been raised only on 2 things. If we have time, I mean, if you don't have time, just stop me, because there were a few more points I needed to make. Now, the concerns about capping of margins on defense orders post 2021, 2 things. Firstly, it's still far away. Second thing, not everything that Bharat Electronics does will come under, I mean, that product profile or revenue profile comes under where there will be margin cap. So there are enough opportunities where Bharat Electronics can earn margins higher than what the cap is. So that concern probably is overdone from the notification or circular which had come from the Ministry of Defense last year. Number 2, concerns raised on disinvestment, where government could from time to time do an offer for sale and keep diluting the free float. I think the thought process with the current government in the last couple of years has been not to do OFS in the broad market, but do it through the ETF route. So ETF route actually sort of does create supply, but that supply doesn't flood the market in that sense. I mean, it is still concentrated holding, which is held for long term by the ETFs, this Bharat 22 and the stuff like that. Okay. So in that sense, there's no serious dilution of free float in the market per se. Yeah. Okay.
Okay, we run out of time. We need to go to the next show. But many thanks to all of my guests. The stocks that we discussed included Manappuram Finance, the Persistent System, and BEL. Those are the long-term bets that you should look at. But with that, it's a wrap on today's edition of Hot Money. Many thanks to all of my guests. Harihar, Sharmila, Vivek, thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.